On the industrial side, silver is irreplaceable in solar panels, electronics, electric vehicles, medical devices, and semiconductors. Demand from those sectors has been growing steadily for years, and that growth is real and well documented. On the financial side, silver has been used as money and a store of value for thousands of years. People buy it as a hedge against inflation, currency debasement, and systemic financial risk. That demand is also real, though it is much harder to forecast because it is driven by sentiment and fear as much as fundamentals. The price of silver is set primarily on the COMEX, the commodity exchange in New York, through futures contracts. A futures contract is an agreement to buy or sell a specific amount of silver at a specific price on a future date. Most of these contracts are settled in cash, not in physical silver. That is not a conspiracy. That is how most commodity futures markets work, because the buyers are often financial institutions hedging risk, not industrial users who need metal delivered to a factory. The physical market, the bullion dealers, the refiners, the industrial buyers, the central banks, operates alongside the futures market, and the two are connected but not identical. When they diverge significantly, that divergence is called a premium. And right now, premiums are elevated. That part is real, and it is worth understanding. So let's look at the numbers being cited in the silver community, because some of them are accurate and the context matters enormously. COMEX silver inventory has been declining. This is verifiable. The registered category, silver that is actually available for delivery against futures contracts, has fallen substantially over the past several months. Numbers in the range of 88 to 90 million ounces of registered silver are accurate as of recent reporting. The coverage ratio, the ratio of registered deliverable silver to outstanding paper contracts, is low by historical standards. The figure of roughly 13% being cited is in the right ballpark. So the people pointing at these numbers are not making them up. Where it gets complicated is the interpretation. A low coverage ratio sounds alarming, but it has been a persistent feature of the COMEX for decades. The market functions on the assumption that not all contract holders will demand physical delivery, and historically, around 1 to 2% of contracts actually result in delivery. That assumption has held through multiple cycles of elevated rhetoric about imminent collapse. Is the ratio lower than usual right now? Yes. Is it at a level that has never been seen before? No. Is it proof that the system is about to break? The data alone does not tell us that. It tells us that the market is tighter than normal, which is meaningful, but meaningful is different from catastrophic. The silver deficit is also real. The Silver Institute, which tracks supply and demand fundamentals, has documented a structural supply deficit, meaning the world is consuming more silver than it is mining for several years running. That deficit is driven primarily by industrial demand from solar and electronics. That is a legitimate long-term bullish factor for silver. It is not a ticking time bomb, but it is a real tailwind. Now, the dealer situation. You may have seen reports of dealer websites going offline by buttons being grayed out or premiums spiking significantly above spot price. Some of this is real, and it happens periodically in the precious metals market. Here is why it happens, without the conspiracy framing. Bullion dealers are small to medium-sized businesses operating on thin margins. When they anticipate that the price of metal is about to move, up or down, they face a genuine business risk. If they sell their inventory at today's price and the price moves sharply before they can restock, they lose money. So they do what any rational business would do. They pause sales, raise premiums to reflect replacement cost uncertainty, or put inventory on hold until the price stabilizes. This is risk management, not a signal that the paper market is fraudulent. Does it happen more often when the market is under genuine stress? Yes. Has this pattern appeared before major price moves? Sometimes. Is it a reliable indicator of an imminent explosion in price? No. It appeared in 2020, in 2021, in 2022. Some of those moments led to significant price moves. Others did not. The Shanghai Premium, the gap between prices on the Shanghai Gold Exchange and Western spot prices, is also real and has been persistently positive. This reflects genuine physical demand from Asia, different market structures, and transportation and insurance costs. It does not mean the Western paper price is a fiction. It means there are different markets with different dynamics, and arbitrage between them is more difficult than it looks on paper. You will often hear three historical events invoked in silver discussions: 1971, 2008, and March 2020. Let's look at what they actually tell us. 1971 is real and important. The closure of the gold window was a fundamental restructuring of the global monetary system. Gold, which had been fixed at $35 per ounce, did eventually rise dramatically over the following decade, hitting around $850 in 1980. That is a genuine historical example of a paper price being disconnected from physical reality, with significant consequences. What the 1971 analogy does not tell you is when a similar event will happen with silver, or whether it will happen at all. The monetary system is different. Silver is not money in the same legal sense gold was in 1971. The analogy is instructive but not predictive. 2008 is also real. The financial crisis was caused by paper claims, mortgage-backed securities, that were systematically mispriced relative to their underlying physical reality. The lesson is genuine. Paper instruments can be mispriced, and corrections can be violent. What 2008 does not tell you is that the COMEX silver market is the same as the MBS market. The structures are different, the regulatory frameworks are different, and the degree of mispricing, if any, is not established by the comparison. March 2020 is perhaps the most useful example because it is the most recent and most directly comparable. Silver premiums did explode. Physical silver was genuinely difficult to purchase at spot price. The paper price diverged from the physical market in a meaningful way. And then the market stabilized, and the paper price moved up significantly over the following 18 months. The lesson from 2020 is that physical premiums can expand dramatically under stress, and that physical buyers sometimes capture better prices than paper traders during those periods. That is a real and legitimate point. The broader economic picture being painted, U.S. national debt, BRICS accumulation of gold, dollar reserve status, contains real elements and overstated ones. The U.S. national debt is real and the trajectory is genuinely concerning to many serious economists. The interest burden is rising. These are legitimate structural issues. BRICS nations, and China in particular, have been accumulating gold reserves. This is documented and real. Where the picture gets overstated is in the timeline and the certainty. The dollar has been declared terminally ill many times over the past 50 years. It remains the world's reserve currency. That could change, and there are reasons to think it will change over a very long horizon. But could change over decades is very different from is changing in the next 48 hours. Silver's gold-to-silver ratio is also real. The ratio has historically compressed during precious metals bull markets. The numbers cited, a ratio of 15 to 1 at the 1980 peak, implying very high silver prices if gold is at current levels, are mathematically accurate. What they do not tell you is whether or when that compression will happen again. So what does all of this mean for someone watching this video and wondering whether to do something? Silver does have genuine long-term demand tailwinds from industrial use. The energy transition is real, and silver is a key input. That is a legitimate fundamental argument for holding some exposure to silver over a long time horizon. The supply deficit is real, though markets have ways of responding to deficits over time. Higher prices incentivize more mining, more recycling, and substitution. Deficits do not always produce the price spikes people expect, or they produce them on different timelines. Physical premiums are a real signal of short-term stress, but they are not a reliable signal on their own. Premiums can remain elevated for extended periods without the paper price catching up dramatically. They can also compress quickly. The risk of holding paper silver through ETFs or futures versus physical silver is real but often overstated. Major silver ETFs have generally performed as advertised. The scenarios in which paper silver fails entirely are tail risks, not base cases. If you are considering buying physical silver, the premium you pay matters a great deal. Buying at a 20 to 25% premium to spot on a silver eagle means the spot price needs to rise significantly before you break even. That is not a reason never to buy, but it is a reason to think carefully about what you are paying. Diversification is the honest answer here. Silver may be a reasonable component of a diversified portfolio for someone concerned about inflation or currency risk. Making it the majority of your financial positioning based on an imminent collapse narrative is a different and much riskier bet. The silver market is genuinely interesting right now. The physical demand from Asia is real. The supply deficit is real. The COMEX inventory situation is tighter than historical averages. The macroeconomic backdrop, debt levels, geopolitical realignment, inflation uncertainty, gives legitimate reasons to think about hard assets. None of that requires a countdown clock or a crime scene metaphor. If you want to understand what is happening in precious metals, the best sources are the Silver Institute's annual supply and demand reports, the COMEX Vault data published by the CME Group, and independent analysis that cites primary sources. Cross-reference anything that sounds alarming. Ask who is selling what and whether they benefit from your sense of urgency. The silver market has been declaring an imminent, explosive move for the better part of 2 decades. Some of those predictions have been partially right. Most of them have been wrong on timing by years or decades. The structural arguments get stronger over time, but that does not make the short-term urgency claims any more reliable. Be informed, be skeptical, and make decisions based on your own financial situation, not on someone else's countdown to 6 p.m. I'll link the primary data sources in the description below. Take a look at the actual numbers and draw your own conclusions. Silver is having a genuinely strange moment, and I want to talk about it seriously, not to scare you into buying anything, and not to dismiss what is happening in the physical market either, because there are real things going on. There is also a lot of noise designed to make you panic. So let's separate the two. I am going to walk you through the actual data on silver supply and demand, explain what is happening between the paper futures market and the physical market, give you some historical context, and help you think clearly about what this means, if anything, for your own financial decisions. No countdown clocks, no crime scene metaphors, just the market as it actually is. First, a quick grounding, because silver is unusual. Most commodities are either purely industrial, copper, oil, iron ore, or purely financial, like currencies or bonds. Silver is both, and that dual nature is the source of a lot of the tension you hear about.